The government just released CPI numbers this morning, and based on that information, we now know what the new inflation rate will be on I-bonds when they reset next month in early May. In this video, I'm going to walk through what happened and why I'm actually selling I-bonds, not buying them. Hey everybody, my name is Rob Berger. This is the Financial Freedom Show, where we talk about investing, retirement, and financial freedom. If those topics are important to you, I encourage you to subscribe to the channel. I also send out a free newsletter every Sunday morning. You can sign up for that with the link below this video. So let's dive right in. So here's what happened. First, here's the CPI numbers. They came in a little bit lower than what the market expected. The rise you can see here was 0.1% month over month. It gives us a new inflation number right here of 5%. I believe the market was expecting 5.1, but in any event, it came in at 5%. And I'm still recording this before the stock market opens, but when that information was released, or it gets released at 8:30 Eastern time, the pre-market futures went up. And they're probably, like the S&P 500 is now looking at an open around 75 basis points higher than yesterday's close. Of course, who knows what's going to happen, but the market generally liked these numbers. But what do they mean for I-bonds? And the long and short of it is, I-bond rates are going to come down, and they're going to come down significantly. My calculation puts it at about 3.38% for the new inflation rate. You take the CPI number from 6 months ago, you take the current CPI number, you work some mathematical magic, and it comes out, there could be some rounding, but I'll put it at about 3.38%. Now, that's just the inflation rate. Remember, the composite rate for I-bonds also includes a fixed rate portion. And it's important to know that we won't have that number until the first week in May. So we don't know what the overall interest rate is going to be on I-bonds in May, but we can look at what it is now. So if we go over to Treasury Direct, and by the way, I'll put links to all of this below the video. The current composite rate right now is 6.89%. 40 basis points of that, 0.4%, whoops, here we go, is the fixed rate. That means that rate, if you buy an I-bond right now in the month of April, it's a 30-year I-bond. That's the term of an I-bond. Of course, you can sell it after 12 months, but you can also hold it to maturity. It would be for 30 years. The fixed rate will not change over that entire 30-year period. That's why they call it a fixed rate. 40 basis points. Of course, as we know, the inflation rate adjusts every 6 months. And set back in November of last year, the inflation rate is currently 6.49% roughly. And when you add the two together, you get this composite rate of 6.89%. As I said, the inflation rate starting next month is going to go down to 3.38 roughly. We don't know what the fixed rate is going to be, but if we assume it stays at 40 basis points just for the sake of discussion, we can add that to the 338. We get a composite rate of about 378. Obviously, a huge drop from the current rate. And we can look at this from a bit of a historical perspective. I know there's a lot of numbers on this chart. This actually comes from Treasury Direct as well. But we can look at when the rates really started to rise, they bumped the inflation rate to 354. This was a couple of years ago. And then it rose to 712, as you can see here. And these are annualized. And then the high water mark was 962, and then it dropped to 648, and that's what we have now. But we now also have this 40 basis point fixed rate, which gets us to the 689. And when this sheet gets updated, that won't happen, I don't think, until next month. That inflation number, again, going to drop to 338. And that raises a big question for I-bond lovers. What do we do? Do we buy more I-bonds this year if we haven't purchased them already? And if we do we buy them now in April, which it may seem like that's a good idea since we know the inflation rate's going down by such a lot. We'll talk about that. Do we buy them at all? And if we already have existing I-bonds, should we consider selling them? So a number of things have happened over the past 6 months, let's say, that to me make I-bonds a lot less attractive. So let me talk about that, and then I'll get to my personal I-bond strategy that I'll share with you for what it's worth. So obviously we've seen the inflation rates gone down. It's going to go down further now. And so that's one big change that makes I-bonds less attractive. On the flip side, for long-term investors, we now have a fixed rate that's above zero. So it kind of cuts both ways. Again, we'll talk about those specifics in just a minute. But a couple of other things have happened that, in my view, certainly for short-term investors, make I-bonds less attractive. Let's take a look at it. The first is the real yield on TIPS. And this actually, I think, makes I-bonds less attractive even for long-term investors. So the way to read this chart, we'll look at the most recent data. This is from yesterday, April 11th. And if we look at a 5-year TIP, the real yield, meaning after inflation, is 1.18%. On the 10-year, 1.4%. And on the 30-year, 1.38%. How does that compare to an I-bond? Well, remember, the fixed rate is roughly the real rate of an I-bond. There's actually a slight additional adjustment to it, but I think for our purposes, we can call it 40 basis points. That's the current fixed rate. That's sort of the after inflation rate that we'll get if we buy an I-bond today. Again, that may change in May. We'll have to see. But right now, 40 basis points. But we go back to TIPS, significantly higher. If we want to compare 30 years, since an I-bond is also has a 30-year term, it's 40 basis points roughly compared to 1.38%. So that's the one big change. If we actually look at trends, this is the 10-year real yield on TIPS. So it would compare to, let's say, this number currently, 1.14. And in fact, if we go all the way out to the current, I don't know how well you can see that. This data is updated as of April 10th, 1.14. And actually, if we go back to this Treasury website for the 10th, 1.14. So it matches up. The thing that I want to point out is it wasn't that long ago, right through here, where the real yields on a 10-year TIP were negative, right? The nice thing about an I-bond is the real yield will never go negative. The fixed rate, the lowest it can be, is 0.0%. But with TIPS, the real yield can, and as we can see, has gone negative, but trends have been changing, of course, and now we've got a real yield on the 10-year at 1.14%. So that's the first big change that I think makes I-bonds far less attractive. We'll talk a little bit more about it in a minute. The second thing is rates on beyond TIPS have gone up as well. So this is from Fidelity. We can see Treasuries are hovering T-bills. So these would be 1-year maturities or less. These first four numbers right across here, as high as just over 5%, and longer durations, mid 4s to upper 4s. So they have gone up significantly, as we know, over the last number of months. We can even look at CDs, and these aren't the highest available, but these are all hovering. And again, I'm focused on this 1-year time period, 3 months to 1 year, the high 4s. We can look at my site, allcards.com. We looked at this in the last video. We've got savings rates. Now, of course, these can change at any moment, but north of 5%. And I was looking at our savings accounts. I was looking at our CD page. We're currently tracking over 800 certificates of deposit, which, by the way, includes some from Fidelity. But they're tracking here, the best we're finding is well over 5%, 5.25%. So we have a couple of things happening. The inflation rate on I-bonds has been going down and will continue to go down significantly. At the same time, the fixed rate went up. That's very nice for long-term savers, 40 basis points, but far less than the real yield on TIPS. At the same time, as we know, T-bill rates have gone up, savings account rates have gone up, CD rates have gone up. Of course, with CDs, you can lock in for 12 months or 18 months or, of course, longer. And so you kind of have I-bond rates moving in one direction with rates on other comparably, I'll call it safe places to hold your cash going up. And so for me, I-bonds, by and large, are far less attractive than they once were. Now, we can break it down into specifics. Let's first talk about a short-term saver, someone who thinks, I'll just keep my money in an I-bond for that required 12 months. I then plan to sell. Yes, I know I'll lose 3 months worth of interest, but maybe it's worth it anyway. Well, at one point it was. Remember, if we go back here and we look at I-bonds going back a year or so, you had an inflation rate annualized of 9.62%. And then, of course, you had to hold it for 6 more months. So you were either getting 7.12% depending on when you bought on the front end, or if you bought when the rate was 9.62, then the second 6 months you got 6.48. You might be able to justify at that point buying the I bond, selling it after a year, losing the 3%, but still doing better overall compared to the rates that were prevailing at that time. Today, I don't think so, because you've got a composite rate of, let's see, it's 6.89. It's going to go down to probably somewhere in the high threes when we get the fixed rate. We'll have to wait and see. So you're looking at maybe a composite rate north of 5%, but remember, you're going to lose 3% worth or 3 months worth of interest. So if I were a short-term saver and I needed the money, say in 12 months, I'd much more be inclined to either invest in a 12-month CD or perhaps a 52-week Treasury bill than I would an I bond. Now, I will say one other thing. If you are still thinking about I bonds for the short term, having some flexibility on exactly when you sell can go a long way. So for example, at the end of 12 months, let's imagine the rate goes down even further. You might be better off holding it for another 3 months so that when you lose that 90 days worth of interest, it's a lower amount. Again, assuming rates continue to fall, this would be when the November rates come out. So something to think about, but still, for me, I bonds don't make sense today if you need the money in the short term, say a year from now. That's true even though if you buy the I bond in April, you do get that 6.89, I want to make sure I get the number right, 6.89% for a full 6 months. As a short-term investor, it just doesn't make sense to me. What about the long-term investor? You say, Rob, I'm in it for 30 years. I'm in it for the long haul. Well, TIPS make more sense to me. A 30-year TIP, we saw the real yield. We can go back to it. Here it is, 138. That's a lot higher than 40 basis points. So if I'm going to keep my bond for a full 30 years, to me, TIPS are the better deal. Now, I suppose come May, the Treasury could release a fixed rate number that's significantly higher than 40 basis points. Of course, if that's your goal, you just wait and see what happens in May. I wouldn't hold my breath, but we'll see. But at least right now, I'd much rather have a real yield of 1.38% on the 30-year TIPS, which, by the way, I know I'll get if I hold it to maturity, than the 40 basis points that I bonds currently offer. The real unknown are for those of you who say, Rob, I'm not going to sell in 12 months. This is not a short-term thing for me, but I don't know that I'm going to hold it for 30 years. I'm not really sure when I'm going to sell. That's where the difference between TIPS and I bonds become really important. And here's the deal. As you probably know, you don't buy I bonds, on the public market. You go directly to the federal government through Treasury Direct. You buy from the government. And here's the important point. When you sell back to the government and you get the face value of the I bond back. So if you invest $10,000 into I bonds, when you sell, you're going to get that $10,000 back, plus, of course, any interest that you've earned. And if you sell before 5 years, of course, you're going to lose 3 months of that interest. But the point is, the value of this bond is not going to fluctuate as interest rates change. When you decide to sell it, you're going to get your full, in this case, say a $10,000 I bond, you're going to get the full $10,000 back, plus whatever interest you've earned and are owed. With TIPS, doesn't work that way. TIPS are publicly traded on the market. Their actual value is going to fluctuate. So you buy a 30-year TIP bond today, that value is going to fluctuate as interest rates rise and fall. As interest rates go up, the value of the bond is going to go down. We saw that last year in 2022, where people were shocked that the value of TIPS went down even as inflation was going up. Why did that happen? Interest rates were rising. Now, of course, if interest rates go down, you make a premium when you sell the bond, but that's the point. You don't know. And if you don't know when you're going to sell, we don't know what the interest rates are going to be 3, 5, 7 years from now. You don't know if you're going to get the par value of the TIP, the bond, or if you're going to get more because interest rates have gone down, or if you're going to get less because interest rates have gone up. That's just the reality of buying, frankly, any bond. That's not unique just to TIPS, but any bond that's publicly traded, their values can fluctuate that way. Again, you hold it 30 years, you know you're going to get the value of the bond back. But if you sell before then, you don't know. With I bonds, you have that security. And for some of you, that might be important. The real question is, for long-term investors in an I bond, do you buy now or do you wait until May? And that really comes down to the fixed rate. I know the inflation rate gets all the attention, particularly when it was over 9%, but as we know, that only lasts for 6 months. If you're a 30-year investor or even a longer-term investor, 5, 10, 15 years, that fixed rate is far more important than the inflation-adjusted rate. So I'll close with this. If that's you, do you buy now and lock in the 0.4% fixed rate, or do you wait until May and maybe get a little bit more? And the answer to that question is, I have no earthly idea. Your guess is as good as mine. I'm sorry if that's not what you wanted to hear. I know there are a lot of folks out there that are going to predict what the Treasury is going to do. I can see arguments for raising the fixed rate. I can see arguments for lowering it. One of the arguments for raising it, of course, is that the real yield on TIPS is so much higher. At the same time, since they raised it to 40 basis points 6 months ago, inflation has come down. That might argue no change or even going lower. At the end of the day, I have no idea. I suppose one option would be buy $5,000 worth of I bonds now and then buy perhaps $5,000 of I bonds in May once you know the new fixed rate. That might make you wish you'd waited, might make you wish you'd bought them all in April. I really think it's difficult to know what the fixed rate is going to do. All of that said, I'm actually looking at selling some I bonds, probably not buying. I have some I bonds that I've held for more than 5 years that have a fixed rate of 0.0%. Frankly, I probably should have already sold them. But if I'm going to be a long-term investor, and with these I bonds, that was my plan, I'd be much better either selling them and then just buying back new I bonds. At least I get the 40 basis point fixed rate. Or, as I've pointed out today, I actually think for long-term investors, TIPS are a better deal. So maybe I invest in TIPS. But if you've got I bonds, particularly if they're older than 5 years, where you don't have the interest penalty and they're at 0% fixed rate, I can't see a reason to hold on to those. So I'll be selling mine. Well, there you go. That's the news on TIPS and CPI numbers and inflation and my take on I bonds as an investment in 2023. A lot has changed over the last 6 to 12 months. At least for me, I bonds aren't as attractive as they once were. Well, there you go. If you have any questions, leave them in the comments below. Maybe you disagree with me. Maybe you think I bonds are still a great buy. Let us know about that in the comments as well. And until next time, remember, the best thing money can buy is financial freedom.